All right, if you're a professional investor, you're going to want to listen up. Forget everything you thought you knew. Those simple, set it and forget it rules that basically define the last decade, they're gone. For 2026, the entire playbook has been torn up and rewritten from scratch, all because we are facing a radically new economic world. And look, this isn't just some hot take. This is the core message coming straight from institutional research. The entire philosophy of buying an asset and just holding on for dear life, yeah, HODLing, is, and I quote, fundamentally dismantled. This is a huge shift in thinking, and as we're about to see, the data backing it up is just undeniable. So just to make sure we're all on the same page, HODL actually started as a typo in a crypto forum, which is kind of funny, but it ballooned into this whole investment philosophy. You buy and you never ever sell. It's the ultimate passive strategy. And you know what? For a while, in a world of super low interest rates and constant stimulus, it worked. But that world is over. So, if the world that made HODLing possible is gone, what exactly replaced it? Let's get right into the hard numbers. The data from the last few years tells a crystal clear story about risk, reward, and exactly why the pros are jumping ship from that old strategy. This backtest data really tells the whole story. You can see a bunch of different strategies here, but let's zero in on the classic buy and hold. That total return of 205%, yeah, it looks fantastic at first glance. But, and this is a big but, the real story, the one that keeps fund managers up at night, is in the next column, the max drawdown. A 32% drop from its peak. I mean, think about that. That is the kind of loss that is psychologically devastating, and it can take forever to recover from. If you're a professional managing other people's money, that level of volatility is just completely unacceptable. It really shines a light on the brutal downside of a pure passive approach in today's market. Now, look at the alternative. By applying a simple, systematic rule, a strategy they call threshold rebalancing, that maximum loss gets slashed by nearly half. It turns a gut-wrenching 32% drop into a much more manageable 17%. Yeah, you sacrifice a little bit on the upside, but the protection you gain on the downside is absolutely massive. So what is this strategy, right? It's actually incredibly simple. Threshold rebalancing is just a set of rules you follow without emotion. You decide on your ideal portfolio mix, say 60% stocks, 40% bonds, and when one of those drifts too far from that target, you automatically rebalance. It forces you to sell high and buy low, taking all the emotion and all the guesswork completely out of the equation. So this data really begs a crucial question. Why now? What has changed so fundamentally in the global economy that these old, reliable rules just don't apply anymore? Well, the answer really comes down to two massive interlocking forces. First, we've got governments spending money on a scale we haven't seen in decades. This creates a dynamic that analysts are calling fiscal dominance. And second, we have a monumental philosophical shift happening at the world's most powerful central bank, the U.S. Federal Reserve. These two forces together are rewriting the investment playbook in real time. This chart shows that first force in action. Just look at the surge in government debt, both in the US and globally. It's staggering. And this isn't just some abstract number. We're talking trillions of dollars creating what some analysts are calling fiscal gravity. Basically, government spending has gotten so big that it's now a dominant force, pulling markets in new and really unpredictable directions. And all this spending is creating a polarized world. The US is projected to grow over 3%, while the Eurozone is struggling to even hit 1%. At the same time, China is stimulating while Japan is tightening. The key takeaway here is that the world's major economies are no longer moving in lockstep. A one-size-fits-all global strategy is just doomed to fail now. Then you have that second force, a huge shift at the Federal Reserve. The expected transition from Chair Powell to Kevin Warsh marks a move away from a reactive Fed to one that is laser-focused on price stability. Warsh's philosophy even introduces a whole new kind of pivot, the idea that the AI productivity boom could allow for rate cuts even while the overall supply of money is tightened. I mean, this is a completely new paradigm for investors. Okay, so that's the new landscape. It's way more complex, more divergent, and a whole lot less predictable. So how in the world are the pros navigating it? Let's move to the new playbook and see how they're shifting from passive investing to active, precision-based strategies. So here's a little peek behind the curtain. Pros are moving far beyond just buying an index. They're dynamically rotating between investment factors, like value, or quality, or momentum, depending on the market environment. They're using complex strategies to separate general market returns from pure skill. And they're even analyzing the market's plumbing, its microstructure, to spot the footprints of large institutional buyers and sellers, finding these tiny edges that are invisible to most of us.
So, how does this new precision playbook translate into real-world investments? Let's take a quick look across the three major asset classes: stocks, bonds, and commodities, to see exactly where the pros are putting their capital to work in this new environment.
In stocks, the AI trade has moved way beyond just the chip makers. It's now all about the picks and shovels. The smart money is flowing into the physical infrastructure that actually makes AI possible. The energy to power it, the cooling systems to keep it from overheating, the fiber optics that connect it, and the specialized real estate that houses it all. The opportunity has basically shifted from the AI's brain to its body. Over in the bond market, pros are being extremely selective. Conviction in traditional U.S. Treasuries is low because of duration risk. That's the risk that rising interest rates will hurt the value of older, lower-yielding bonds. So instead, they're finding better returns in more complex areas like mortgage-backed securities and the private credit markets. And finally, commodities. The focus here is squarely on industrial metals that are facing huge structural supply deficits. We're talking about the key ingredients for both the energy transition and that AI infrastructure boom we just saw. Copper is being called the strategic priority of the year, and uranium is seeing a massive resurgence to power all those new data centers. All right, I know that was a lot of information, so let's bring it all together. Let's distill this entire professional playbook down into 5 clear, actionable pillars that really define the core of the 2026 institutional strategy. Here it is. 1. Replace emotional HODLing with systematic rebalancing to protect against volatility. 2. Instead of just buying the whole market, actively rotate between investment factors to adapt to changing conditions. 3. Add real assets and infrastructure to your portfolio to tap directly into that AI build-out. 4. Use active bond managers who can actually navigate a world of higher, more volatile interest rates. And 5. Focus on precise execution, because in this more complex market, every single small advantage matters. So the takeaway is clear. The simple, passive strategies that define the past decade are being replaced by a new era of active precision. This new landscape of fiscal dominance, central bank transition, and technological revolution demands a more thoughtful, more disciplined approach. So the only question left is your strategy ready for the change?